Hi, folks. Dan Bird with the Daily Scan for Tuesday. It's Technical Tuesday. The market has closed at 6 p.m. on the East Coast, and got a few things to cover. So let me jump into it real quick. We're going to talk about Max Payne tonight, of course, because this is options expiration week. So we'll see what Max Payne has to say about what might happen. And then I'm going to also talk about the measured move. What is a measured move and how do you calculate it? I'll talk about that in association with some patterns, some technical patterns. So that's what we're going to cover today. As always, I am not a financial advisor, so this is for educational purposes only. All right, let's first take a look where we left off earlier today, which is the 10-minute charts for the S&P. And then I want to show you something interesting. So when I reported earlier, it was around 11:30. We were right about here. The market had just begun to start going back higher, and I said, it'll be interesting to see how it closes. Well, it closed lower. In fact, there are lower highs all day long. So that is now becoming bearish. Interestingly, though, technology stayed up there. So technology is still leading. Financials, everything else is down. You can see industrials is kind of going sideways, but everything else was down. We ended the day with a big down candle the last 10 minutes. That doesn't necessarily mean anything because, as you'll notice, the end of each day, the last 10 minutes, that's where market makers rebalance their books. So there's usually huge volume in that last 10 minutes. And it can be very volatile. So it can go up and down, and doesn't necessarily mean that's going to happen at the open the next day. It could actually reverse and go the opposite direction. So don't pay too much attention to that. Well, you can pay some attention to it, but not too much attention to that last candle. But overall, these have been going down all day today after an initial gap higher. So here's the defensive, healthcare down, staples, energy, utilities down initially, but try to come back up, and materials down. So everything looks like it's down except for technology. And then if we look at the rotation area, same thing that I showed earlier, growth versus value is going higher. Discretionary pulled back a little bit. Technology stayed up there, semis and internet. So technology is carrying the market right now. Everything else, every other sector is pretty much down. So we'll see what that means when we go into tomorrow. And that leads me then to the next thing that I want to show you, which is on the bias matrix page for subscribers right here, market bias matrix. Oh, by the way, I'm going to do a monthly Zoom meeting this Saturday for any subscribers. I haven't done this for a couple of months, so anyone that's interested that is a subscriber, if you're interested in joining, just go to the website, click on this button right here. It will take you over to this page, the webinars and newsletters page, and the Zoom meeting is right there. So you just need to click on that on Saturday, July 19th at 1 p.m. Eastern time. And I typically start off by talking about anything new that I've added to the website, answer questions about the website, how to navigate, different things that are available that you can check out. And then we open up to questions, and anything goes. You can ask me anything. We can discuss the markets. We can discuss the economy. We can discuss individual charts if you want me to look at certain things. So that's pretty much what happens. And you can see down here, I record these. The last one was in May, was 2 hours long. They typically run between 2 and 3 hours. If I have a hard stop, then it's usually 2 hours. But it's really dependent on what anybody wants to ask. So anyone that is a subscriber is welcome to join. And that includes monthly subscribers. And if you want to just on the homepage at the bottom, if you want to sign up for the monthly subscription right here, it's a 7-day free trial. So you can sign up for that, join the webinar, see if there's any value for you. And you'll also learn what's on the website. So you'll have 7 days to check it out. And then if it's not for you, then just cancel the subscription. Easy as that. All right. So I just wanted to bring that to your attention. So let's take a look at, go back to the market bias matrix page. And interestingly, even with the market kind of selling off today, market bias page went up, the market bias chart went up slightly today. And there were a number of bullish boxes. So the Dow Jones got a long-term bullish. There were some bearish ones in here as well, but you can see there were more bullish than bearish. And that's what kind of pushed it up. And even on the day over day, week over week, overall, we have a green signal, and long term, we have a green signal. The other two are caution. So that was interesting. However, watch this. I'm going to show you what I see every day when I go through this, and I update these every day. It doesn't take very long, and you'll see why the way I've got this set up. But it's very interesting when I did it today. One thing for me is it gives me a sense for how the market's moving. So I'm going to just start with the S&P right over here. And I'm going to go right down the list. We'll go through the sectors and industry groups. I probably will stop there. Might look at gold and Bitcoin as well, but let's start here. So I'm going to do this very quickly, but you'll get an idea pretty quick. So S&P, you can see it's just been in a nice uptrend ever since April. April 7th was the bottom right over here, continually going up. Today had a big red candle. So that's that downtrend that we looked at a few minutes ago. Hasn't really broken the chart yet. The 5-day is still above the 10, and everything is still above the 21. So the chart is not broken. This is the previous high right here at 61.50. But take a look at what all of these look like. Now pay attention to this. This basically opened up here and closed down here. So pretty much was selling off most of the day. We'll look at the rest of them. There's the NASDAQ. Now, NASDAQ, of course, is technology. So that's the one area that held up. Here's the Dow, NASDAQ 100. There's the S&P 100. Here's mid caps, big sell off there. Small caps, big sell off there. New York Stock Exchange. Here's the Russell 2000, big sell off on that one. Here's growth. Again, mostly technology in the growth area. So it's a black candle, which means it opened at the high and sold off. And by the way, it's at an all-time high too. So could that be a failed breakout? Here's the value. Value sold off hard. Transportation, utilities. Now we're into the sectors. There's technology, the one area that held up. Communications. By the way, communication is a bearish engulfing candle. It completely engulfed the previous day. There's discretionary. Here's staples. So everything other than technology, everything's moving down. There's utilities, healthcare, big sell-off in healthcare. There's energy, 2 days in a row on that one. There's materials continuing to go down. Here's industrials just beginning to move. There's financials, big downtrend. There's real estate. Here's retail. Semiconductors is the one area that held up. Software hanging in there, sold off previously, but hanging in. Clean energy, not bad. There's artificial intelligence, of course, the one area that's holding everything up. There's cloud, autonomous vehicles. This is cybersecurity. There's biotech. Biotech had a really nice run up, huge sell-off today. That also is a bearish engulfing candle, touching the 200-day almost to the tick, and then selling off hard after that. Here's home construction, big, huge downtrend on home construction. Transportation heading lower. Here's insurance continuing to head lower. Here's banks. Banks have just been reporting lately. Here's regional banking selling off. Now these are the relative charts. So this is discretionary versus staples moving lower. Here's NASDAQ versus the S&P. It's up there, but big black candle, so it ended lower. Transportation versus the Transportation versus the Dow Jones Industrials. This is Dow theory right here, and that's selling off. Transportation versus utilities. Transportation is weaker. Here's growth versus value, way up here, but sold off all day. So open, gapped up, so way up here, then sold off all day. So that could be a sign of a broken breakout. Now this one's interesting. This is the Magnificent Seven versus small caps. So you can see the big gap up. Magnificent Seven is what's holding it up. The large cap tech stocks is what's holding everything up right now. And comparing it to small and mid caps, the Russell 2000 had a really great run. So it's definitely outperforming, but selling off all day. Here's large cap growth versus value. This is mid cap growth versus value. And this is small cap growth versus value. You can see as we go through each of those three, all of them opened higher, closed lower, closed at the close of the day, closed at the bottom of their candle, which means that if the market had stayed open longer, it would have gone lower. Large cap, mid cap, small cap. So you can see where the direction is. Here's CRB. Here's oil. Oil selling off a little bit more. Light crude, Brent, gasoline, natural gas starting to make a comeback. Here's commodities, agriculture continuing to go lower. Corn still down there. Soybeans selling off. Cotton trying to make a comeback. Actually, cotton is the one good one. Lumber had a huge day yesterday, way up here, and lumber actually still hanging in. And here's gold. Gold continues to try to struggle to get back up. And this is, I think, primarily because of momentum. So momentum traders just will not believe that gold can go down. So they'll step back in and push it higher. But the bears, I think, are looking like they're starting to win. Now, it does have two higher lows. This is not quite a higher low yet. It hasn't gone back higher. So it could continue down. So we'll have to watch gold. By the way, gold is one of the ones with a bearish short-term trend, had bearish downtrend today. Gold miners, the same thing. It had a signal today, bearish signal. Here's silver. Silver was the one that was holding up of all of these, and now it's starting to roll over. Silver miners looks the same. Platinum starting to head lower. Steel, big downtrend on steel today. Copper's hanging in there near the top. Lithium, right at the 200-day and now starting to move lower. Uranium continuing to go higher, of course. Metals and mining had a really great run. Big red candle today. US dollar is making a comeback, like I've been saying for the last few days. It's now above its trend line. So the US dollar actually is looking pretty good. Bitcoin, after a really good run, had a big red candle today as well. Bitcoin has been highly correlated with the NASDAQ 100. So technology stocks have held up there. Bitcoin held up with them. And now Bitcoin is starting to look like it's going lower. The 10-year is going higher. So that was one of the bullish changes. Here's TLT, the 20-year bond going lower. This is the yield curve, the 10 and 2 yield curve, still well above zero in this case. And then the shorter term, 2-year minus the 3-month, 2-year minus the 3-month is well below zero. Zero is way up here. So this is inverted for the shorter term, but it's starting to make a comeback too. All right, that's all of them. I do that every day. And what you can see, hopefully, is while the market is still up there, it's still bullish, just like the market bias chart is showing. A lot of those are starting to fall apart, starting to crumble. If they continue to do that, we're going to start to get a lot of bearish signals over here. And it'll start usually on the short-term side. You can see there are lots of green over here right now, this the short term. But those are the ones that will start the process typically. And then it will go to medium term and then long term. So once that begins, then we're still a ways away from it. So this pink line has to cross the blue line. 5-day has to cross the 21-day. So we are still probably a week away from that happening. But next week starts the weakest period of the year, July 21st, which is next Monday. So we could easily get down to that level. And then when we start crossing, then all of these are going to start giving bearish short-term signals. The Dow's heading there now. So got about a week to go. But when those things start giving bearish signals, they're going to start doing it very quickly. And you're going to see that market bias chart start to roll over significantly. When that happens, then the whole market is starting to head lower. We still have probably another week, another bullish week. So let's take a look at, or we may have another bullish week. So let's take a look at max pain and see what that is telling us. So max pain basically is the equilibrium point between puts and calls. So this is all the options are expiring on Friday. If there are more calls like there have been, meaning everybody is bullish, then that means in order for market makers to pay out the least amount of premium, they would like for all of those stocks to start to go lower. So these calls end up expiring worthless. And there are fewer puts on this side. So that would imply that the max pain means that the market should go down. And that usually happens towards the end of the week, around Thursday, and carries over into the first couple of days of the next week, Monday and Tuesday. So that's how max pain works. If the market had done the opposite, if the market had been selling off, then in order for market makers to pay out the least amount of premium, they would want the market to come back up and have a nice rally into options expiration, meaning all of those puts that people were buying would expire worthless. And so you think of it kind of as opposite week. If the market had been going up, then max pain means it likely is going to go down. So let's take a look at max pain and see what it might be telling us. Let's see, where did I put my max pain chart? Right here. So first I want to call out Earnings Beats. This is Tom Bowley's site. They do lots of really good research. I'm a subscriber here. I highly recommend that you subscribe to their site. It is a little bit pricey, but they have some really great research that they do, especially with some of the chart lists that they create. It's all integrated with stock charts. So if you're a stock charts member, then it's the ideal add-on to that, because everything they do will automatically open up in stock charts, and much like on my site. And also, the chart list that they provide will allow you to then save it to your own stock chart site. So Earnings Beats is a really great site. I highly recommend them. Here's Tom Bowley right here. He also does lots of, he does a live trading room on Wednesdays. A lot of what he does, if you're take a free trial, you'll be able to participate in all of that. And he also does quarterly updates of the market, where the market's heading. He has been very, very accurate in what he does. A lot of what I've learned of technical analysis comes from Tom Bowley, as well as a number of others. But this is a really great site. So he's the one that puts out the max pain report. So we're going to take a look at it. He also, on his site, has the max pain spreadsheet where you can do max pain on any other chart, any other stock that you want to. I'm only going to show a few of them here. But if you want to look at individual names, there's a spreadsheet that will calculate max pain for you. So the way max pain is figured out, as I mentioned before, is simply taking all of the call premium and all of the put premium, totaling up what all of those are, and then subtracting one from the other, and whatever you get, if it's a negative number, that means the market will likely go down in order to reach max pain. So the first three up here is the S&P, the NASDAQ 100, and the Russell 2000. And as you can see, to reach max pain, or to reach equilibrium, it implies that the market will likely sell off into the end of the week and the first couple of days of the next week. So for the SPY, max pain level is 593. Now let me go bring up a chart. Here's the S&P right here. And let's look at it here. Actually, let's look at it this way. So 593 would put it, oops, that's the actual index. Let's do SPY. So 593 on SPY will put it right about down here. It's pretty low, pretty far down. 593 is down here. So that is at a critical support area just below the 50-day moving average. So not likely that it's going to go that far. That is only about a 6% downtrend though. So certainly could do 6% in that amount of time, but likely won't go that low. And I want to point out that the max pain is not really telling you the absolute target. So it's only almost 5% down to get to 593. Now it started with last Friday's close, which was 623. And today we are at 622. So it's pretty close to last Friday. So that's only almost about a 5% loss if it gets all the way down there. That is a major, right about here, 593. That is a major support level. You can see this was the high right there. This was a low right there. So that's support right in there. So could it get there? Yeah, it could, but probably won't go that far. However, could easily get down here to the 21. You can see every time it hits the 21, it bounces back up. So I've mentioned that before. The 21 is at 613, so it easily could get there. And the previous now support back here at 609, I call it right about 600. 600, it certainly is a target that it could hit. So that's kind of how max pain works. Let's look at the Qs. The Qs down 5.75% would be down to 522. Let's see where that would be. 522 would put it right down here. Same place, same support level. So there's resistance right there, now becomes support. So went down and touched it right at the 21. So that would be about 5.75 decline if it were to hit there. Also right near the 50-day. So likely not going to hit that by Friday, but it could certainly, or Monday or Tuesday of the next week, but it could certainly get to 545 down here where the 21 is. So again, it's not necessarily telling you the exact price level. It's just saying what the overall direction will likely be this week. The opposite of what it had been doing. So it had been going up. So opposite means it's coming down. So there's the Russell 2000. Max pain on the Russell is at 209, about 5.5% down. 209 would put it, let's see, 209 is right there. So 209 is right at this was resistance right here. Actually was the inverted, it was actually the neckline of the inverted head and shoulders pattern that we had here on the Russell 2000. So 209 is right there, right at the bottom of this support. And also just below the 50-day, below the 200, below the 50. Had a big, huge down day, down 2% today. So could it go down 5.5%? Well, it went down to almost 2% just today. So sure, it could do that by Friday. Absolutely. That would put it right down here. Probably won't go that low, but it certainly could. So max pain is telling us that the market is rolling over. The big question mark for me now is, since it is the weakest, going into the weakest time of the year, is that going to continue and continue sending the market lower? We shall see. Just to take a look at some of the other stocks, and this is based on net premium. So obviously the ones that the larger names are going to be near the top. So NVIDIA down 19%, not likely. Meta, Microsoft, MicroStrategy, actually Strategy, down 15%, not likely to go that low. But the overall implication is that they may go lower the rest of this week or into next week. Now, these are the ones that have been holding the market up. Like I showed you before, basically everything from probably Netflix up. Those are all the stocks that have been holding up the market recently. So they are certainly very extended, but AI is getting a lot of play right now. So that could continue higher. And if we go down to the bottom, that'll show us the ones that have been pretty much selling off, which means Max Pain implies that they should go up. So Adobe, Workday, Duolingo, Salesforce team, these are ones that have been selling off lately. So they actually might be able to take advantage of Max Pain. United Healthcare sold off significantly. It's well below 304. I think it's down to like 291 or 292 today. So United Healthcare had a huge sell-off today. There you go. Big red candle there, 291, almost 292 today. It's actually right at my original buy point right there. But because I've been selling covered calls and I sold another one last Friday that expires this Friday, but the strike price is 310, so it's not likely going to go back up to 310. Certainly could, but that means my covered call will expire worthless and I will keep that premium, and it will push my basis now down to about 282 right now, down to about right there. So my basis is right down about there. So my break-even point basically is right there. And if this comes down or reverses and goes back up, then I'll do it again. I'll sell another covered call and push my basis down to below 280. But I'm not going to lose money. If it does go down there, or not going to lose much anyway, hopefully. If it does go down that low and starts to go below what my basis is, then I will just get out and chalk it up to an interesting experience with covered calls. But we'll see. We'll see what happens, especially with Max Pain. This is one that Max Pain could actually, the beneficiary could be to the upside for Max Pain. But we don't know. This one in particular, I think, because market makers, there's probably a lot of puts on this one, especially after today. Probably a lot more people have puts on United Healthcare. So market makers would love to see that one end higher than all of these put buyers so that they expire worthless. We'll see. We'll see what happens. All right, so that's Max Pain for today. If you want the full report or how this is calculated, or actually the spreadsheet on calculating your own stocks, just go to Earnings Beats. I highly recommend them anyway. You can sign up for the 30-day, I think it's a 30-day free trial, and then you can attend a number of their sessions and learn more about technical analysis and how Tom Bowley does it. All right, so now for the second part of Technical Tuesday, which is, actually before I get to the second part, I'm going to do a stock that a subscriber asked me about. Second part is the measured move. I'm going to talk about that. But let's talk about Procter & Gamble, because a subscriber asked me to take a look at this. They said it's at a 52-week low. So here's what it looks like. Obviously, below the 200, below the 50. This is a close-up view of it. Continuing to go lower. This one probably, actually, you know what? I'm going to see if it's in the Max Pain report. It might be. That's a pretty large one. It would be down here somewhere, probably. Procter & Gamble, PG. Yeah, there it is right there. PG, Procter & Gamble. So Max Pain says 159. That's not much of a move, actually. So there are not as many puts on this one as I thought there might be, but there are more than calls, certainly more puts than calls, but only a 1.25% move, 157 to 159. So let's go back and look at this again. Right now it's at 152. So now it's more than 1.25%. So last Friday it was up here. So 157 would be right up here, right around the 200-day moving average would have to get to. But let's take a look at this on a wider view. So this is a full year right here. You can clearly see the downtrend that this is in. And yes, it is at a 52-week low. One thing that we can do to try to determine where this might be headed and what the question was, what does momentum look like on this? So we can just draw a line, and these are not exact points. I like to try to draw it, near the open and close. So that's what that one would look like. One a little above it 2 times, but we'll take that same one and duplicate it. You can do this in stock charts and move it down here to see where. So there's 2 touches on that one. So this might be the target right down here of where it's headed. So let's see what that means. So that is the channel that it's been in ever since the end of last year. Let's now take a look at it on a weekly chart. And we'll do the same thing. On a weekly chart, by the way, it doesn't quite look as bad. Now, yes, below all the moving averages except the 200-day. So the 200 looks like it is a key support level. And if I put in a support resistance line right here where this was resistance over and over again, basically 1, 2, 3, 4 times, and then it broke through right here. So this now is support. Pretty good support too. Put it right at the closes, opens and closes as close as we can right there. So there's support right there. You can see it came back down to this and then bounced off of it. It's right about 150. We're at 152 right now. Let's do the same thing over here and draw that same channel. And again, we'll draw it from here. Oops, that's not what I want. I don't want a vertical line. I want a trend line. Draw it from right here. So that's the same tops that we had before. And we'll duplicate that and move it down to this level right here. And what you can see is, I'll draw a circle around this. Right there. Looks like pretty critical support. So we've got the bottom of the channel. We've got the 200-day moving up to meet it, and we have very important support, which used to be resistance, right at 150. So that, to me, I think is the target. This is on a weekly. The momentum still potentially has more to go. But interestingly, on the weekly, if it were to bounce right about here, it would be bouncing right at a bullish area. So you can see overall, the trend still is going higher. It's still not below these levels down here. But this is a critical point right here, right at 150. It's a round number. It's got 3 support levels to negotiate. That looks like the place where it's going to probably bounce. Now, it could bounce back up to the top of the channel and then turn around and go back down again. If we look at this on a monthly basis, now that doesn't look too bad at all, does it? In fact, looking at the monthly, let's look at where this 50-month is right at 148. So again, that 150 level right there. And in fact, I can turn on I'll turn on Legends, make it default, and it will tell me what the 50 is. 50 is at 147. So this is a 50-month. Remember, this is a monthly chart. But the 50-month, basically, this is a 1-year moving average line, roughly, this red line. So it's also right at the 150 level. So looking at all of this combined, I would say Procter & Gamble, if it continues down, which it likely will with the rest of the market, 150 is going to be a very important critical level of support. It needs to hold that. Probably will hold it at least temporarily, and then we'll see what happens from there. If it breaks through that, then it's probably going down here to 120. So, but the 150 is the next one. That's a really important one, and it's actually not very far away from it. All right, now let's look at measured move. What is the measured move? So measured move in technical analysis is for certain patterns, you can measure the move um, using consolidation theory in this case, but there are other patterns too you can use it on. Basically, it's measuring the move up to a pullback or consolidation, either sideways or down. And there's a couple of ways you can do it. If there's a downtrend like this, you can measure it from the start of the uptrend to yeah, I can't really click on it. Start of the uptrend to where it rolled over, and then take that measurement and add it over here to where this starts to uptrend again. So you want it to break through this downtrend line, which implies a change of character. And then the measured move, the potential target, you would add the same length from this side, you would add that length to this side. And then the target would be right up there. It's pretty much right where this one went to. This is Walmart from the year 2000. So that's what a measured move is. That's a bullish measured move. You can do it in a bearish as well. Typically, this explains it down here, continuation, advance, length. You take, starts from 30, goes to 50, that's a $20 move. If the consolidation correction was to 40, so roughly in the middle, then you would then take the 20 and add it to the 40, and you would get 60 for the measured move. 60 would be the target. You can do the same thing on the downside. So there are bearish measured moves exactly the same kind of way. I'm going to show you this on different types of patterns. Certain ones are really good for measured moves. So this one like this is great. Also one that comes down and goes sideways and then goes down. So if it goes sideways, you can probably expect it to continue. That's a continuation pattern. So going up is a continuation pattern, believe it or not. It's a continuation bearish pattern. So you always want to be careful. Intuitively, you think, oh, it's recovered. It's starting to head higher, which it could be. But the reversal usually comes at around the 62% level. So you can use Fibonacci's to figure that out as well. 61.8 or 62. It's roughly right at that level. So that if it's going up like this, if it reverses right at that 62% level, then it probably is going to be a continuation pattern to the downside. You can use the measured move to figure out where the target would be. So that's pretty much how it works. Let's look at a couple of patterns over here. Let's look at a double top reversal. So this is a double top. I want to point this out because I did have a subscriber that was asking about a double top on the S&P and suggested that I look at the futures, which I did, and they pretty much showed the same thing, very similar. And I'll explain to you why that really wasn't a double top. And it's important to understand this. So this one right here is a double top, went up, came down, consolidated sideways, went up, hit a double top. So the measured move on something like this is the distance to where the bottom was. This is basically a Darvas box. In this case, the Darvas box broke to the downside, and the measured move would be pretty much the distance of the box. So it would put the measured move down here to about 46, and that's where it consolidated, and then in this particular case, continued to go lower. So a measured move does not mean that it's going to reverse and go higher again. It just means that that's the target of this move, and it could consolidate and go sideways for a while, which then would be another measured move down again. But in this particular case, the measured move would be 46. But the important thing about double tops is right here, decline from the peak, decline from the second peak should witness an expansion in volume or an accelerated descent. And then the important thing here is that the low between the peaks declines at least 10%. So that's important. That did not happen recently on the S&P. So you want a pretty significant decline. You want at least a 10% decline, and then coming right back up and hitting that previous high, basically creating resistance. And then it bounces off resistance and breaks through where the bottom was. So that's the first thing you have to think about. It needs to be at least a 10% decline. The second thing is most important aspect is avoid jumping the gun. Wait for support to be broken with an expansion of volume. So don't anticipate that it's a double top. It is not a valid double top until it breaks through that bottom support. It also is important that there's something in here about the length of time. Yeah, right here. The peaks should be separated by about a month. If the peaks are too close, they could represent normal resistance rather than a lasting change in supply and demand picture. So that's the other reason why the recent, what looked like a double top in the S&P was not a double top, because it was too close. It was only within a week, those two peaks. So it was too close, number one, and it did not have a 10% decline. Same thing with a double bottom. It basically works exactly the same way. You wait for it to break out of the peak. So looks like a W. This is a great, the double top looks like an M, double bottom looks like a W. So you want to wait for it to break out of the middle of the W. And then you measure the distance, and that's the target for the double bottom. Head and shoulders. This is a head and shoulders top. In this particular case, these are great for doing a measured move, because number one, you can see them for a very long time. You can see them forming left shoulder, head. As soon as a pattern like this happens and it starts going lower, you can clearly see that there's a left shoulder and a head. So then you want to wait to see if there's a right shoulder. And as I've always said, it's not a pattern until it breaks. So in this particular case, the neckline is down here where these two came down and met. And then it started going back up again. And then it becomes a true pattern when it breaks through. Now, in this case, the measured move is from the neckline to the head. So in this case, it's 80 down to 45. So that's about 35 points. So the measured move would be down to about 10. In this case, it went down to about 20. It looks like about 20 down here. It's certainly not finished yet, but it certainly got down here to about 20. So that's where you can calculate this ahead of time to roughly figure out where the target would be if it breaks the neckline. Head and shoulders bottom is the same thing. This is an inverse head and shoulders. So again, it needs to break the neckline. And when it does, then the measured move is from, in this case, 375 up to about 525. So that's about $1.50. So that would be a measured move of about 675 right up here, right up in this area, which is pretty much where resistance would be anyway. That's back to these tops over here. So that's the way that you can calculate them. If you have a falling wedge, falling wedges like this are bullish. So in a falling wedge, the target typically is the top of where the wedge began. So in this case, the measure move has not completed yet. So the measure move, basically the measure move would be, you can measure from that top to where the wedge began right here, or you can measure from the top down to the bottom of the wedge. So 8.5, 15.5, so about 7 points. So it's going to go right back up to that top again. Rising wedge, same thing, except this is bearish. So this one would be heading back down here to the bottom, which is exactly what it did, to the bottom of the wedge. Rounded bottoms are the beginning of a cup and handle, which we'll look at in a minute. So in this case, this is basically just regular resistance. And so you can measure the time in this particular case, 36 weeks on this side, 37 weeks on this side. And then once it breaks out, it's going, likely the measured move will be from the bottom of the cup to the resistance line. And that would be the measurement for the target up to the top. The measurement is the same for a cup and handle, just that the execution of the cup and handle is a little bit different. Triple top, triple bottom is the same as double top. Flag and pennant. So this right here, you can see the flagpole. So this was where the previous consolidation was. Then it broke out and it moved higher. And then it came down, made a lower point and made a lower high, and then made a higher low. So it's not sure which way it's going to go. This is indecision. So you just draw a line across the tops and create the flagpole down to where the consolidation was right there. And in this case, the target would be the length of the flagpole. So down here is 7, here's 7 right here. So the target would be right here once it breaks out. So it has to break out of this pattern. The thing about these patterns is you don't know which way it's going to go because it's indecision basically. But once it breaks out through the top, then you can measure what the likely target is going to be. And this one is a perfect example of that. Symmetrical triangle, same kind of thing. So it's symmetrical on the opposite side as well. So you've got a kind of like a measure from the top down to the bottom of this trend line, and from the breakout to the top up here, same distance, and that's the target. Ascending triangle, this is clear resistance, so it cannot get through that level. It's the same level, same point all the way across. However, it's got higher lows. So this is bullish typically, because even though it can't break through the top, it's not going as far down each time. So once it does break out, then you've got, here's the measured move right here. It's the distance from the bottom back here to where this resistance level is. That's the measure move. Same thing with the descending triangle, just the opposite. Rectangle is a typical Darvas box. So again, the measure move would be the distance of the box itself, and then it will consolidate and maybe continue to go lower. All right, finally, cup and handle. So cup and handle is very similar to that rounded bottom, except that it doesn't break out. It doesn't break out of that resistance level. It comes back down and forms a handle. But the handle should not be more than about, let's see if it tells us here. Cup depth is about 1/3, should retrace about 1/3 of the previous advance. The handle right here, 1/3 of the cup's advance. So about 1/3 of the distance. Duration, a cup can last from 1 to 6 months. The longer it lasts, the more powerful it will be. This is a favorite of Investors Business Daily. So you want the handle to be about 1/3, no more than that. You don't want it coming way down here. It can come less than that though. But the breakout point is right here. You can see it here. Breakout. Once it breaks out, then the measure move is from the bottom of the cup to the resistance line. That should be the same distance that it will go to the upside. So that's measured move. That's how to calculate them, how to use it with patterns. As you continue to look at charts, you'll start to recognize those patterns. They'll jump out at you pretty much. So have fun with it. If you want to learn more, come back to this page. This is on stock charts. So on stock charts under Chart School, you can just look for chart patterns, shows you all the patterns, and it talks about measured move down here. So you just go to stock charts, and go to the homepage on stock charts. Let's see if I can get to my return to stock charts. Homepage on stock charts, go to Chart School, just type in here, patterns, and there's chart patterns, and we'll take you to that same page that I was just showing you. All right, so that's how you can get to it. So good luck with that. Good luck with the rest of the week. We'll see how it works out. I'll report at the midpoint tomorrow to see how the market's doing, to see how Max Payne is playing out. And we'll see what happens going into the end of the week. One last thing I want to mention is, which I didn't yesterday, or actually I should have probably done it today, but yesterday we did get a short squeeze alert on iRobot. So this happened at 2 p.m. yesterday. So it was after my session, my midday session. I didn't send out an alert because I wanted to see how you always have to get a confirming candle the next day. And what we actually got today was a shooting star candle. So these are very risky as always. So you decide whether you want to play these. These are typically stocks that have more than 20% of their float short. So when they move, they can move very quickly. I did have a subscriber ask me about this one and one other one, iRobot, and I mentioned to him that it was kind of an interesting coincidence because it actually hit the hit the short squeeze alert hit yesterday on this one. The other one that he mentioned, which looked pretty good yesterday too, it did not hit the alert because it didn't go up enough, but it also is on the short squeeze list. So it looked like it was going to have a short squeeze as well. It did not hit the alert because volume needs to be above average. And volume was not above average on this one yesterday. If we go back and look at iRobot, you see volume yesterday was above average. So that's what I'm looking for. I'm actually looking for 125% of volume above average. And on the short squeeze list, which means more than 20% of its float is short. And a couple of other things that I'm looking for. I'm looking for it to end near the high of the day. I'm looking for it to be above the previous 4 days. So the close needs to be above the previous 4 days. So that it implies that it's making a move higher. But then we need to get a confirmation. So you can see right here, this has been on the short squeeze list. And every time it tries to go up, shorts step back in again and short it again. So shorts would have felt pain back here, right here at this level. So you can see that's the candle from yesterday. So that's where the short squeeze started. There probably are more shorts up here. So the next area where shorts are going to start to feel pain is if it gets up here to about 650. It's about 450 right now. If it closes this gap right here, gets above the 200-day and gets above this line right here, shorts are going to feel a much more pain. Right now, this candle today, I think, might be shorts stepping back in again, saying, oh, I've got another chance to short it once again. So we'll see what happens, but it's worth watching that. There was one that I posted a couple of weeks ago that actually worked out pretty well. I'll show you, which actually was on my scan today, BVAI. So this hit right back here. This hit the short squeeze alert right back here. You see the next day's candle looks like the shorts tried to step back in again. This could be the same thing that happens with iRobot. And then it took off. So the short squeeze alert was right here at 521, and it went up here to 8. So that's about 40%, 50, actually it's $3. It's about 60% gain in about a week. So you don't want to necessarily hold these forever because these are very fast moving. So it looks like short stepped in again right here and it started to move down. So this is why I was on my scan today, because it had a pullback to the 21 and starting to move up again. So this one actually might have another run ahead of it. But that's a really good example of what the short squeeze alert can do. And whenever I see them, they don't happen very often. Whenever I see them, I will let people know. I'll talk about it on the midday report. Also, for those that are subscribers, you can go to the chart lists and scans page, and about halfway down on the left-hand side, you'll see the short squeeze candidates. So these are all the stocks. There are 57 this week. Last week, there were 51. And this is the criteria. Short interest, percent of float has to be more than 20%. Average daily volume, 100,000 shares. Market cap, 100 million. So I want things that have liquidity. And these are U.S. stocks. So those are all on this list. If you want to create your own scans, you can download this. This is a CSV file. You can import it into your own platform, any platform that you use, including stock charts. But this is the list that I run the scan against right there. So 57 stocks on there this week. All right, that's it for today. Thanks for watching. Please like and subscribe, and stay tuned tomorrow. We'll see how this market's going to play out for Max Payne the rest of the week. Thanks, everyone. Take care.